In this video, we cover the following: why the current market still looks bearish longer term, the current status of the 2008 bear market analogy, new bearish developments on weekly charts, our table of long-term bearish signals, some short-term things we're watching heading into Thanksgiving week, and we discuss long-term concerns that we still have about the NASDAQ and technology stocks. We're looking at a daily chart of the SP 500. Let's just hit the high points. The main takeaway here is nothing has happened off of this October low that makes the current daily chart of the SP 500 look like a bull market. Price is below the 200-day. That's what a bear market looks like. The slope of the 200-day moving average is tilting downward. It has a negative slope. That looks like a bear market. The 50-day remains below the 200-day. This is that death cross. That looks like a bear market. We recently tried to take the 200-day, which currently sits at 1270, twice, and twice we failed. You could argue that this is a short-term double top, which tends to be bearish. What to look for here? Obviously, any break above this 200-day moving average, if we can stay above it and we do it in a forceful manner in terms of price and volume, the longer you stay above it, and more importantly, if the slope of this 200-day can start to tick up, that favors the bulls. This is the 50-day moving average. Here, from a bearish perspective, if we break the 50, the longer we stay below it, the more bearish it is. And again, more importantly, if this slope can roll over, that leans towards the bearish camp as well. To put some historical context around the previous chart, this is the 2007, 2008, 2009 bear market daily chart, S&P 500. Bear market starts, you come down, you make a low. This is similar to the October low in 2011. There was a monster rally. Everybody declared that the bear market was over, that the bears were getting creamed. It was painful to be a bear here. Notice the 200-day moving average. In 2008, the slope is negative. Also notice the slope almost flattens out here, which is very, very similar to the slope on the chart that we just looked at in the present day. Price rallied all the way back to the 200-day moving average, actually popped above it. This is very similar in terms of the technicals, the weekly charts, the long-term sell signals. There's a lot of similarities between this point in 2008 and the present day. After this, the S&P 500 dropped 16.67% in a fairly rapid manner. The main point is this whole rally off of this low was wiped out in a very short period of time. Then we had a pretty good rally here. There's certain things that you would look for at this type of low. If this happens, and we're not sure that it's going to happen, there's some things that we need to see, but the setup is there. If we got something similar to this, there's certain things to look for here, and this is where you might sell or cover some of your deflationary or bearish positions. Off of here, we got a counter trend rally. Notice the slope is still negative, and from this point here, the market dropped another 48-49% all the way to these lows in March. Present day still looks similar to this. This is a bear market. There was more pain ahead. We move now to a weekly chart of the S&P 500. Some developments last week as of the close on November 18th that lean towards the bearish end of the spectrum. We came off of this low here. We crossed over the 22-week moving average, which currently sits at 1228, 1229-ish. This is bullish here, but notice the slope of this line never turned over. Last week, we closed below the 22-week moving average. That's a bearish development, something that's different from these weeks. The slope of this also appears to be rolling over. That's bearish. The 22-week moving average is a good way on a weekly chart to look at the health of a market. Look at last week's candlestick here. Looks somewhat similar to this candlestick, and notice here, this is starting to roll over in a similar manner here, and we closed below the 22-week here, and we closed below the 22-week here. declines followed. But maybe the most important thing here is this is the weekly MACD histogram. Notice here it's moving up. Here it ticks down. This is different. This tends to be bearish. So we tick down here. We also, for the first time in quite a while, tick down here, especially ticking down above the center line. This leans bearish on a weekly chart. Next, we're going to look at the risk-reward ratio of having this tick down, the MACD histogram, on a weekly S&P 500 chart when you're in a bear market, or when price is below the 200-day moving average and the 50-day is below the 200 on a daily chart. This looks complicated. It's not. What we're looking at here is when the weekly MACD histogram turns down, as it did on the previous chart, what has that meant historically? So in the last two bear markets, in the dot-com bear market and in the last financial crisis, there were 10 instances where you had that MACD histogram tick down from above the center line when you were in a bear market as defined by a daily chart. All we're doing here is looking at, there were 10 instances. 1 week after that happened, here are the instances where the market went up. Here are the instances when the market went down. The average gain was 1.2%. The average loss was roughly 2%. That's this average. 40% of the time, 1 week later, you were up with an average gain of this. 60% of the time, you were down with an average loss of this. We can then calculate a risk-reward ratio. The risk-reward ratio comes out to be 0.4. Looking out between 1 week and 12 weeks, the risk-reward ratio is very unfavorable when that MACD histogram turns down in a bear market, as it did last week. This is an updated version of long-term sell signals that we've gone over before. We'll just go through this quickly. You can go to the Shivako Capital channel and get more details on what this chart means looking at past videos. Point, fairly simple. Most of the sell signals, long-term sell signals, are still in place. The exceptions are the Bollinger Bands for the S&P 500. We'll look at that. Dividend stocks, we'll take a look at that. And crude oil looks tired on a daily chart, but still may have some more upside. But the overall overriding theme remains and leans in the bearish camp despite the rally that we had off the October low. Here is a monthly chart of the S&P 500. These are Bollinger Bands. We've looked at this before. When priced, the black line tends to be above the center line, tends to be bullish. This is a bearish crossover. Stocks went down, bullish crossover, stocks went up. This chart goes all the way back to 1996. Point we want to make here is notice in the early stages of this bear market, we crossed big counter trend rally. Came down here, early stages of a bear market, big counter trend rally. This is where we are today. Came down, crossed, big counter trend rally. Now there is a difference. The other counter trend rallies did not cross the center line. We have crossed the center line. That doesn't necessarily mean that we can't move back down. This is currently on a relatively neutral or a buy signal. We closed on Friday the 18th at 12:15, and this center line is at 12:15. So we're basically at a neutral signal. Point being, if the S&P 500 goes below 12:15, then we'll be back on a sell signal, and we'll be looking more like this, and more declines followed, or looking like this, and more pain followed. It's helpful to look at markets in different time frames. We normally look at, in these videos, at daily, weekly, and monthly charts. This is a 60-minute chart of the S&P 500 as of Friday's close. Here we held the easiest thing that would happen from our perspective in terms of managing would be for this market to hold here or to hold somewhere between 1200 and 1204 on the S&P 500. If we hold in this area, it'd be nice to see a bounce come back up somewhere. Perfect case would be around 1263-ish in this area here to the top of this trend line. If we did that in a weak manner, it might be an excellent entry point for conservative bear market deflationary type assets. You'll notice here when we broke this trend line right here, so breaking this trend line, markets have a tendency to rally back to those trend lines. So we just broke this trend line here. It's possible that we could rally all the way back in the 1280 area. If we were to do that, we would be looking at price and volume and a lot of other indicators. But again, moving up in this area in a weak manner might actually be the easiest thing to manage through. The most difficult thing to manage through would be if we come down early in the week and the area around 1200 doesn't hold and we come down closer to 1180. You'll see here when we peaked, we went all the way down to this green trend line. So it's possible that when we peaked here, we're going to come all the way down to this green trend line. Now, if we bounce, then it's possible we're going to go up. The hardest thing to manage through now is if we just come down here hard. We'd really rather see us move back up and do it in a weak manner, but we'll just have to see how things unfold. Short takes has a lot of entries from about Wednesday to Friday of last week that go through some of these scenarios in the short term. Understanding that this looks very complex, we're not going to spend a lot of time on this. Just want to give you the basic concepts of how we're monitoring the markets. On the previous slide, we said we're not sure if the outcome in 2011 is going to be similar to 2008. All this is things that we're going to be looking for on daily charts, weekly charts, and monthly charts. Everything that we check off here. So if it turns red, it says the slope of the 200-day is negative. It was negative at the peak in 2008. It's true today. RSI on a daily chart peaked at roughly 65 in 2008. The recent peak in 2011 was roughly 65. The more of these that we can check off as we go forward this week, if we can, the more red that we see here, the higher the probability that we're going to see bearish outcomes and a continuation of the bear market. So this is just a way for us to monitor things in the next week to 10 days. This is a monthly chart of the NASDAQ Composite Index. These are exponential moving averages on this monthly chart. We've been over these things before. When the shorter red exponential moving average moves below the longer blue exponential moving average, that tends to be bearish. We got a bearish cross here. We got a bear market. We got a bullish cross here. We got a bull market. Point of showing this is, notice in the last bear market, we got the first cross. We came down. We came all the way back up on a counter trend rally and went above the blue moving average. That's basically exactly what's happened here. Bearish cross, counter trend rally, counter trend rally. The point here is price is now below the blue line as it was here, and the red line remains below the blue line as it did here. What happened next was that the bear market continued. So the point is the NASDAQ's rally off this low is really not out of character. We saw something very similar here, and yet the bear market continued. This is the MACD histogram for the monthly chart. When the histogram's above zero, that tends to be bullish. Bullish, we got a bullish reading here, stocks went up. Bullish reading here, stocks went up. Bearish reading here, stocks went down. Currently, we've got a bearish reading, and also notice this is ticking downward. The last tick was down. That tends to be a bearish signal. This is a bearish crossover. This is a bullish crossover, black over red. This still looks bullish. This still looks bearish. Black under red is bearish as of the close on November 18th, 2011. This is another monthly chart of the NASDAQ. This is the 11-month moving average. Concept here pretty simple. We're looking at a slope here. The slope rolls over, tends to be bearish. Slope rolls over, tends to be bearish. The point is this slope has started to roll back over, And notice we tested the moving average here, which is common in a bear market. We tested it here and failed. We tested it here and failed. Came down a little bit more. In this bear market, we came down. We had a counter trend rally. We tested it. Counter trend rally. We tested it. Slope remained negative. Bear market was still in force. We've come up here and tested it twice now. We remain below it as of the close on November 18th, and this is starting to roll over in a bearish manner. So what we would want to see from a bearish perspective is a continuation of this. If we pop back up above in this area, price, or this turns up, that would favor bullish outcomes. Right now, this is still looking like the early stages of a bear market, but we'll just have to see how it plays out. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.